Welcome to Chapter 16, Equity Portfolio Management. That's right, I'm wearing a cowboy hat. I'm inspired by Indiana Jones. He was a college professor. Let me get this hat on right. And I'm a college professor. And, Harrison Ford walks around with a spiky hairdo and a little girly earring in his ear. And I really prefer the Indiana Jones character, so I thought I would wear my Indiana Jones hat today. I was out hitting golf balls earlier today because I am an excellent golfer, and to think I gave up the senior golf tour to teach here at Harding University, I don't know. I must really love you kids. But anyway, it's a little chilly outside. Got to keep the dome warm, and so I thought I would give you guys a treat. Let me make sure this hat is angled properly. Make sure I'm showing there you go. Yeah, perfect, I think. So anyway, let's get into chapter 16. And this is my cowboy uniform, or not uniform, but costume that I had when I was 6 years old. I think that might have been a Freudian slip. When I was 6 years old, I wore this outfit trick-or-treating. And yes, I was a very large child at 6. All the basketball teams wanted me. All the football teams wanted me. I think Nick Saban actually made me an offer to attend Alabama when I was 6 years old. They thought I was going to be as big as Shaq, but it just didn't turn out that way. But I stopped growing when I was 7. So anyway, let's get into chapter 16. Enough of the stand-up comedy routine. Equity portfolio management. All right, so I'm going to leave my hat on for a while, keep my head warm. All right, there are two basic approaches to equity portfolio management: passive and active. And let's not get confused between approaches and styles. We talked about styles in chapter 13. We talked about growth and value. Those are styles. And we're going to go over those styles again in this chapter. But let's distinguish those styles from passive versus active. So let's get into the details of passive versus active. So a passive management style, first of all, is long-term. It's for your long-term money. It's kind of like the bison offense. It's not a quick strike offense. It's a grind it out, down in and down out, and take it up the field, and you're going to own the time of possession. And it's the same thing with passive management. You're not going to get a quick strike typically. It's long-term, and it's buy and hold, so you set your asset allocation and you implement that asset allocation, and then you keep it in place for as long as it is appropriate to do so. And the goal of passive management is not to beat your market index. That's the goal of active management. The goal of passive management is to match the performance of a target index. A passive strategy should be adopted if a person believes the market is efficient. And I believe that for the most part the market is efficient. And if the market being efficient means that investors cannot consistently outperform the market. And that is what happens. Investors do not consistently outperform the market. I haven't seen one study in my 37 years of being in the investment business that shows me that any investor can consistently beat the market, and particularly beat it on a risk-adjusted basis. There are periods of time, such as 1995 to 1998, when the S&P 500 absolutely trounces or smokes active managers. During that period, 93% of active managers underperformed the S&P 500. I have not found a time period remotely like this when active managers outperformed the benchmarks, and to even the same extent, even close. There's not any other time period where active managers turned around and trounced the indexes, but there are for periods of time when the indexes outperform the active managers. And studies show that over a 20-year period of time, only 1%, it's actually less than 1%, of managers outperform their benchmarks. Why would you pay a manager fees to underperform? And speaking of fees, that's a big problem with active management. active managers must overcome transaction costs because active managers trade more frequently than a market index, and that costs money. That takes away from the performance of the portfolio. And active managers charge a fee that index managers do not charge, okay, a much higher fee. Remember, an index has no fee. An index manager has a very low fee. The typical fee for an actively managed fund is about 1.25%. It could be as high as 2.25% depending on what type of portfolio you're talking about managing. And we'll get into that in the next chapter, I guess in the chapter on investment companies. I guess that was the previous chapter, chapter 15. The fees can be as high as 2.25%, but the typical equity fee is 1.25% annually. The typical fee for an index equity portfolio is about 1/10 of 1%. Okay, so about 95% less for an index fund. All right. So there are three ways to construct a passive index portfolio. The first is full replication. And what that means is all the securities in the index are purchased in proportion to the weights in the index. So you're replicating, completely replicating the index in your portfolio. There are problems with this approach. There are a lot of transactions that have to be done that cost money. And then there are dividends that are issued and have to be reinvested, and that costs money. Okay, so anything that costs money will lower the return. Okay, so to combat this, some managers have come up with a sampling method to put together their portfolio, and that means buying a representative sample of stocks that comprises the index. So you're trying to match the index, but do it with fewer stocks, fewer transactions. Okay, these fewer transactions result in lower costs. The problem is performance will not track as closely as under the full replication method because there are differences between a sample portfolio and a full replication portfolio. Okay? The third method is optimization programming, and that's really a similar to sampling, only it kind of takes it to the next level. It uses computers and historical information on security prices and correlations in order to build a portfolio that will track an index. So your index may not look anything, your portfolio may not look anything like the benchmark, but it is constructed based on historical information to act like the index, like the target index. The drawback is the software relies on historical information and relationships that held in the past but may not hold into the future. So there are two things when you're looking at picking an index. There are two things that an index fund, if you're trying to pick an index fund for your client's portfolio, two things to monitor, and they are fees and tracking errors. So the fees do vary among the index funds, okay, from very, very low to not so low, and also tracking error. And tracking error measures how closely a fund performs relative to the index it is emulating. So how closely does the fund track the index that it is trying to emulate? All right, so that's passive investing. And yes, Dr. E is a passive investor. I believe in passive investing. Then there's active investing. And this is an attempt to outperform on a risk-adjusted basis, not just to outperform, but to outperform on a risk-adjusted basis, a passive benchmark. Okay? Alpha is a concept that measures any return that exceeds the expected risk-adjusted return, and this is what active managers strive to generate. In other words, there are two ways you can outperform. One is by taking more beta, and if you take more beta, are you really outperforming? That is the question, and the answer is not really. If you take a certain amount of risk and you generate a return that is higher than what you would justify taking the risk, then you are generating alpha, and that's what managers strive to generate. Unfortunately, very few managers consistently generate alpha. Okay? So how do you choose that benchmark? The normal portfolio is very critical. When you're building your portfolio, you have to pick a benchmark that you're trying to emulate, and that benchmark needs to be consistent and appropriate for the client, and the portfolio needs to be consistent and appropriate for that benchmark. You want to compare apples and apples, okay? So the benchmark has to reflect the objectives and constraints of the client and the characteristics of your portfolio. You cannot build a value portfolio and compare it to a growth index. Not fair, okay? One key to success with active management is to persist with an active style through good times and through challenging times. This is because investment styles cycle in and out of favor. I've shown you this chart that shows when value outperforms, growth is underperforming, and when growth outperforms, value is underperforming. And so what happens is, if you're a disciplined manager, a portfolio manager is trying to put together a portfolio for a client, and that portfolio manager is trying to expose the client's portfolio to different areas of the market, different styles. So here's what happens. They say, well, we want 25% of the portfolio in value and 25% in growth. And then here's what happens. You get 2 or 3 years into it, and value has been outperforming, and growth has been underperforming. And the growth manager is worried about getting fired because they've been underperforming. So what they do is they start drifting toward the value style in order to try to help the performance of their portfolio. And that is a mistake, because the financial planner, the quarterback for the client, wants a certain amount in growth and a certain amount in value. And if the growth manager starts becoming more of a value manager, then those lines get blurred and you have a problem controlling your exposure to the styles. So I've been there before. I was a growth manager. I worked with value managers. I know what it's like to underperform. I know what it's like to watch someone else, another style, underperform, and it can be pretty lonely and pretty scary when you get into that second year or third year or sometimes even fourth year of underperforming. Then you are tempted to move your portfolio toward a different style. You must resist that temptation. All right, so how do managers, active managers, beat their index? Well, there are 3 basic approaches to beating an index, okay? And the first one is market timing. Market timing involves shifting funds into and out of stocks, bonds, and money markets, okay? Changing your weighting. Some market timers are very extreme. They'll go to 0% in one or two of these asset classes, or they'll go to 100% of one of these asset classes. Other managers work somewhere in between. They have a long-term asset allocation, and then they will fine-tune or tweak that asset allocation. Okay? And you make your movements, you shift into and out of these asset classes based on forecasts for these asset classes and based on estimated risk premiums. What does this mean, risk premiums? A risk premium is really a multiple. And remember this, the higher the multiple is for a security, the more you're willing to pay for it. And the more you're willing to pay for it, the lower your risk premium is. When you are optimistic, your risk premium is low. When you are pessimistic, your risk premium is high. When should you be buying securities? When the risk premium is high. When people are scared, time to buy. We looked at that in technical analysis. When the risk premium is low, people are confident, time to sell. And so market timers will look at economic forecasts, they'll look at forecasts for these asset classes, they'll look at multiples and risk premiums and decide how they want their asset allocation to look, okay? So you're going to be in these classes when they look cheap and out when they look expensive. The problem with this approach, and there's a big problem with it, this approach does not work. The academic studies show that it does not work. The problem is that stock prices rise and fall in very concentrated moves. I'm going to show you some charts that will blow your mind, okay? Therefore, missing just a few key days in the market, either up or down, can drastically affect your returns, okay? All right, let's take a look at these charts that I just mentioned. So here's the impact of missing some key up days, okay? So what this table does is it looks at the S&P 500 over a 20-year period of time, 1998 to 2017. Over that 20-year period of time, there were 5,036 trading days. Okay? The average return for the S&P 500 annualized over that period of time, 7.2% a year. Okay? If you missed the 5 biggest gaining days because you were a market timer, if you missed the 5 biggest trading days, up days, then your average annual rate of return was 5%, not 7.2%. And you might say, oh, that's not much, really? Well, over that period of time, if you had invested $10,000, it would have turned to $26,600. If you had kept it in, if you had missed it, if you had gotten those 5 days, if you kept it in the whole time, you would have earned $40,000. So if you had invested $100,000, it would have turned into $266,000 if you had missed those 5 days out of 5,000 days, or it would have turned into $401,000. Now you tell me how important it is. Okay? If you missed the 10 biggest days, 3.5%. Your return would have been cut in half if you missed the 10 biggest up days in the market. 10 days out of 5,036 days. And your $10,000 would have turned into $20,000. Your $100,000 would have turned into $200,000 instead of $400,000. Okay? All right, let's see what happens if you miss the key down days. Okay? Missing the key down days had an even bigger impact. Your portfolio would have earned 9.5% if you were able to miss those key down days. Up to 19% a year if you had missed the 40 days with the biggest losses. Again, we're talking about 5,036 trading days, and we're talking about the impact of missing 5 to 40 days in the portfolio in that out of 5,000. Who on this planet could pick the days to be in and the days to be out? And the answer is no one. No one could do it. All right, so very few managers are right often enough to make this method worthwhile. I'll tell you a quick story. Several years ago, I had managed money for a client for a few years, and he came to me and said, I'm going to take some of the money that I have with you. I have a friend in the business, and he's had some pretty good returns over the last couple of years, and so I want to move some of the money from you to him. And I said, I understand. How much do you want to take? He wanted to take a quarter of it. I said, okay, what is he doing? How does he manage money so I'll know how to manage my portfolio so we're not duplicating each other? He's a market timer, he said. Well, I must have grimaced because he said, I can tell from the look on your face that you don't approve. And I said, I'll be honest with you, I do not approve. The studies show that market timing does not work. So he gave the guy 3 years, and 3 years later he came back to me with that 25% of the money because that guy had dramatically underperformed. Market timing does not work. All right, the second way that active managers add value is through rotation. This is keeping funds invested in stocks, but shifting into various economic sectors or into various investment stocks. Okay, and so and you do that based on, once again, how you think these things are going to do over the near or intermediate term. And so this strategy incorporates top-down investing, where you look at the economy, you look at the industry, and you look at the company. And so what I wanted to show you is the economic sectors in the S&P 500, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, and 11 sectors. And where you are in these sectors really has an impact on your portfolio. For example, in 2018, if you overweighted consumer discretionary and information technology and healthcare and underweighted consumer staples, materials, and financials, you would have done very well. But if you made a mistake and you underweighted these areas and overweighted these areas, you would have done very, very poorly. So this is how the index looks, and your job as an active manager is to decide how your portfolio is going to look compared to these weightings. Okay? And again, diversifying by value versus growth, the gray area down here, these are periods when growth outperforms, and these are periods when value outperforms. So managers who rotate will move into and out of these styles based on what they think is going to happen. The problem is, just like it is with market timing, how do you know when to make the move? How do you know it's time to get out here and time to get in here? And then it's time to get out here and time to get in here. No manager can do it. They try, but as I mentioned earlier, 1% of managers over a 20-year period of time outperform. And that indicates to you that managers do not do a good job of making these calls. All right, and then lastly, bottom-up stock picking. And this is what you think of with active managers. What active managers try to do is maybe equal, in terms of value and growth, you have both in your portfolio, maybe 50-50. In terms of the economic sector weightings, you have very similar economic sector weightings, but here's the difference. When it comes to weighting individual stocks in those sectors, you weight them differently. That's how you add value. So you use computer databases, this is common, to screen for stock investment opportunities. You use criteria such as valuation. There's certain valuation to look for. PEs, if you're a value manager, low PEs. If you're a growth manager, high PEs. Okay? Maybe the size of the market cap of the company, which is the number of shares times the price per share. Some managers are large cap managers, some are mid cap, some are small cap managers. Okay? Company fundamentals, maybe you're looking for a certain amount of sales or a certain pace or rate of sales growth or earnings growth. Maybe you're looking for leverage, maybe you're looking to avoid leverage. Okay? Maybe you're screening stocks based on stock price movement. Maybe you're a momentum investor and you're looking for stocks that have been going up. Okay? Or your relative strength, meaning that you're looking for stocks that outperform in a down market. Okay? And then lastly, sensitivity to economic variables, which is similar to beta in that maybe you think the economy is getting ready to pick up, and if so, you're looking for the stocks of companies that are very economically sensitive. So this is how managers do bottom-up stock picking. You look for certain traits, and then you overweight or underweight. Okay? So you screen the database to find companies or stocks that meet this criteria in order to narrow the list to a manageable level, a manageable number. So there are 10,000 stocks out there, and by the time you finish screening, you might come up with 200 stocks. And then you start going through them one at a time. Okay? You then complete your analysis by further evaluating individual company situations. Okay? And what that means is you're doing a lot more work on these individual companies. You're doing your ratio analysis. You are talking to the management team. Okay? You're talking to customers of the company. All right? Sometimes managers formulate quantitative trading rules and they run them in historical context to determine their efficacy. What does that mean? That means you say, if I look for a portfolio that had certain traits, how would it have done over time? Okay? And this is called backtesting. And I have done this throughout my career where I have come up with different approaches to picking stocks and managing portfolios. And I've said, hey, what would have happened if I had done it this way from 1990 to 2017? Okay? It's called backtesting. All right, two other styles that you need to know of when it comes to managing a portfolio. We've already covered this: growth stock investing and value stock investing. Okay, the primary focus of growth stock investors is the potential for earnings growth. Okay, growth investors attempt to analyze the products and services a company has to offer, the potential market for these products and services, the barriers to entry, the things that will keep competition out, and the potential substitutes, things, once again, that could be competition, and the lead time a company has over its competition. We are looking for companies that are going to grow in a superior way over time. Okay? Growth investors tend to be visionaries or dreamers who do not require instant gratification. You don't have to, it doesn't have to go up right now, but over the long term, you're looking for explosive growth. Okay? We're looking for the next Google or the next Facebook, the next Apple. Okay? Growth stock investors are not very concerned with stock valuation measures. Okay? We're much more concerned with sales growth and earnings growth and the size of the market than we are with stock valuation, because we feel that a company's growth will drive the stock price over time, and that eventually the fundamentals will catch up to high PEs or high price to books. In other words, if a stock is trading at 100 times earnings but it's growing at 75% a year, the growth of the earnings base will quickly make that PE lower. Okay? They'll buy stock. In other words, let's look at it this way. Let's say you got a growth stock and it's trading at $40 and the earnings are $1. Okay? That makes the PE 40 versus the market PE of 18. That makes it a growth stock, okay, a really high PE. But here's the thing. This company, let's say that they grow earnings 100% next year. You got $40 divided by $2 equals a PE of 20. And let's say the market grows its earnings 10%. And so that would make the market, that 18 divided by 1.1 would be something like 1.8, let's say 16, about 16.2. All right? So look at the difference now. So we got a PE difference here of 22 times and a PE difference here of only 4 times. Why does that happen? Because of the growth rate of earnings. Growth will solve the valuation problem. Okay? The goal of a growth investor is to sell, you buy high and sell even higher down the road. A value stock investor buys low and sells higher. A growth stock investor buys high and sells even higher. All right, let's see, last slide. No, maybe 2 more slides. Okay, value stock investing. Let's look at value stock investing. The primary focus of value stock investing is stock valuation, PE, price to book, price to cash, price to sales, dividend yield. My partner was a value investor. That's all he looked at, these valuation measures. Try to buy them cheap. Buy those stocks cheap. Low multiples. Value investors tend to look for stocks that have declined in value, okay, to the point that the current stock price does not reflect the value of the company's assets or potential earnings, assuming just an average operating environment. So what happens is value investors look for companies that have stumbled. They're not doing well. The valuation has gotten very, very low. The expectations are very low. And all they're counting on is a return to an average environment, not even a good environment, just average. Okay? Can you buy those value stocks at very low multiples? Okay? Okay, that's it. That's it for now. That's the first clip. Let's sign off, take a break, let my brain start to cool down and your brain start to cool down. Until then, howdy, partner, and adios, and shalom, and buonasera, and that's Italian, and I don't know. I'll have to look up some other foreign languages to say peace. Salam alaikum.